Using my computer audio. I will start soon as people start jumping on. What's going on? Thanks for jumping in here. Do me a favor in the chat. Let me know if you can actually if you can hear me okay. I don't have my external mic, so I want to make sure that I can hear, and sorry, that you guys can hear me. So as you jump in here, do me a favor and let me know if you can hear me. That'd be really, really helpful. You just put a 1, or you can put yes or something like that if you can hear me okay. Looks like my mic is working and everything else is working, so I think I'm good. Let's see. What I need to do is close out some of these. What I will do in the next, I'll start in the next minute or two. This is going to be about 30, 35 minutes, maybe 40 minutes tops. And if you also there's a chance, join my Facebook group. I'll actually type it in the comments. But the reason is that's where you'll be able to find the replay. It'll be literally in the it'll be streaming into that, and you'll be able to see it there. The group name is Economics, so you can check that out. Let's make sure I can get this going. There we go. So as people start coming in here, what I'll do is, hey everybody, I want to thank you for jumping in and watching this webinar today. The whole point today is to give you the value that you can use for your business and for yourself as an individual. You're probably wondering why I'm doing this. Well, I'm getting a lot of questions from people about tax reform. And today's webinar, we're going to be talking about how the tax reform changes of 2018 will affect your tax returns and how to prepare for them to save money. In essence, you're hearing a lot of misinformation in the media. This is not a political statement. This is just a reality of it all. When I watch people on TV talk about the tax cuts and the tax reform bill, and they're saying things that are in many cases asinine, it's laughable. And so what I wanted to do more than anything else is to give you guys some of the things that I think you should think about going forward for 2018, but also for 2017, the things that you should actually think about when you want to get ready to do your tax return. Additionally, what we do for tax prep, it's called the 250 Tax Pro. That's probably where you found the site to get here. Maybe you're watching this in a Facebook group, but it's called the 250 Tax Pro. Very simple, and I'll tell you quickly why we did that. It's supposed to be a quicker way to help individuals and entrepreneurs get their tax returns done and to get advice moving forward. In many cases, depending on your facts and circumstances, your return could be done in as little as 250. That includes the state. And the reason why that is because we use a process to have them prepared. Now, you can go to places like Jackson Hewitt and Liberty Tax Service or H&R Block, and they spend tens of millions, if not almost $100 million in advertising to get you to go there. So you can go sit in an office And when they tell you that their returns are free, here's why they're telling you that. Because in many cases it is. Like, you probably, the only thing that qualifies is a 1040 easy, which literally is a 1 page, maybe 2 pages, and you have no itemizations. You have one W-2. You take the numbers, put your address and everything else at the beginning of the form. Put your W-2. No really additional deductions except the standards, and then after that, your tax return is done. That literally takes 7 minutes. Okay, because that's why they do it for free. Now here's how they get you to pay money. They charge you for e-filing. They charge you for the state return. You have to do a state return because everybody lives in a state. You do a state return in many cases, so they charge you for that. They charge you for the e-filing, and at some point, they end up getting you close to about 60, 70, 80, maybe $100, even though you thought it was free. So, again, that's their business model, and then maybe they want to sell you other products, and I have no problem with that either. That's not my bag. For us, is to get you in and out, get your returns done quickly, get them done right, and also too, the people who are doing your returns at those places, they're not CPAs. Some of them are even barely enrolled agents. They just, they take the intake and then they follow a checklist and they fill it out, and then it doesn't get reviewed and it gets signed by somebody who most likely is an enrolled agent. Again, if you're an enrolled agent, it's not a problem. I mean, you're more than experienced. I'm just saying how they, get people. It's like the McDonald's situation. If you want, a $15 hamburger, don't go to McDonald's, right? The quality of the beef, the quality of the experience. There's a chef or somebody making the burger and seasoning the meat, and maybe you have Kobe beef. I don't know. But if you want a dollar burger that costs about 5 cents to make, go to McDonald's. Go to Jackson Hewitt. I don't have a problem with that. Now, I told you what we're going to talk about today. As I continue, let me introduce myself to you if you don't know who I am. Maybe you've seen me. You've seen my site. You've seen the 250 Tax Pro. Maybe you're part of the group. Maybe you see me online, social, Twitter, Facebook, YouTube, Instagram, a whole bunch of different places. Either way, I'll give a quick introduction for those who are watching. My name is Ebong Eka. I'm a CPA in the Washington, D.C. area, entrepreneur, and additionally, I'm also the best-selling author of Start Me Up to No Business Plan. And I spend my time helping small business owners and individuals, not only with taxes, but also with their leadership development, as well as their business, creating business strategy for them to excel in the new year and currently where they are. You may have seen me on television like Fox News, MSNBC, China Central, Rise TV, a whole host of different networks, including I-24 News, which is a new one I recently joined. And I go on, I talk about small business, not only internationally, but also I talk about global business as well. I talk about the individual and how taxes affect them by giving people tips and tricks and strategies in order to save money. And I've been in this business for a little over, let's say, a little over 15 years. So almost 16 years. I've been doing tax accounting, business strategy, entrepreneurship, all in that space. So I spend my time learning, perfecting my craft, learning the new things, the nuances of what's going on in the tax bill, and then I want to bring it to the people like you guys who are watching today. So if you have any questions, you could throw them in the chat. That'd be great. I appreciate that. And then I won't answer them right away, just to be clear. At the end, I'll take any questions that you may have, and let's get started. So the first. Today I told you in the free training we're going to talk about how everybody's confused with a tax plan, and I'm going to share with you I'm going to share with you the strategies and deductions that many people are missing out on every year, and especially how it affects this new tax bill that was signed in 2017 for 2018. Because if you know what to do in 2018, your 2018 return is going to be very fruitful for you. I.e., you may save money, you may get additional tax deductions. You may pay less taxes, right? That's the whole point of this. And then you can use that money like AT&T and some other companies did and give them to your employees or buy some new equipment. So the first thing we're going to talk about, if you're taking notes, you want to write this down, you can make an A. The first section we're going to talk about today is the top 4 deductions and strategies you don't want to miss for 2018, okay? Now, the first one I want to share with you guys is the 20% pass-through. A 20% pass-through deduction, which is huge for so many small business owners. And I'm gonna go through the criteria of what that basically entails. And here's why. What happened recently after that was announced, there needed to be some clarity as to the actual numbers and the limits. And so I was waiting to get that. So thankfully I got that. One of the things this is going to affect, if you're a doctor watching this, if you are an attorney who earns a lot of money, you're going to phase out of this. Okay. So people who are doctors making, we'll talk about the threshold, but if you're a doctor or some type of a medical practitioner, maybe a dentist, and you're over the threshold, the additional 20% deduction is not going to be for you. You phase out of it. So the whole point of the additional 20% deduction was literally to help small business owners who are maybe who are in the infancy of their starting and making maybe low six figures or less than that. I mean, the average entrepreneur probably makes about $40,000 to $50,000 a year in general. That's basically the average for a small business owner. So this is literally to help them to get an additional deduction, and not for the person who's making $500,000 to $1 million. Okay. So in essence, what happens with the pass through? I'll give you a quick example. I mentioned earlier, you have the ability to take the deduction, but it phases out if your taxable income is greater than $157,000. It's not a lot of money for many small businesses. If you've been in business for a few years, you most likely make that in a month or maybe 2 months. But either way, if your taxable income exceeds $157,000 individually, if you're as an individual filing single, or if you file jointly, it's $315,000. So it could be something as simple as this. Like I said earlier, many physicians are going to actually phase out of this, and they'll be subject to the limitation. But if you're in a service-based business, your phase out will start at $315,000. So this also includes all forms of income. So this is taxable income. So if you have income coming from stocks and bonds, income coming from some other interests, interests from investments or any type of other income coming in. This also includes everything that's part of this. Okay. Now let me add another thing too. Qualified business. I'm going to read this verbatim. Qualified business is generally income from a partnership, S corp, sole proprietorship, and also LLC, right, in which the taxpayer is an owner. Now, in the case of certain services, the ability to take the deduction phases out for taxpayers with taxable income over $157,000 for individuals and $315,000 for joint returns. Now, this is basically for certain service-based businesses. Okay. Now, additionally, for income from service-based businesses, the phase-out begins at $315,000, and once a taxpayer's total taxable income reaches $415,000. For joint filers, or $207,500 for individual filers, the 20% deduction is fully phased out. So your phase out starts at $315,000, and it literally phases out at $415,000 for people who are filing jointly. Individuals is $157,000 to $207,500. Okay, so if you're in that range, you should be good. Get ready to get an additional 20% deduction. It's going to be amazing. It's going to be fruitful. Now, some people have asked me, what should I do if that happens? Should I, if that happens, should I, not make as much money? That sounds crazy. Don't do that. What you should do is make as much money as you possibly can, right? Even if you phase out of this additional deduction. Okay. Also, there's also limitations for W-2, people who have W-2. So sometimes small business owners have a pass-through, like they have a personal or single-member LLC, and they also have a full-time job, okay? So there's different phase-outs for that as well. So I'm also give you this other point here. So taxpayers outside of service businesses with taxable income above the threshold amounts mentioned above, subject to different limitations. So for those taxpayers, the 20% deduction may not exceed the greater of 50% of wages paid with respect to qualified trade or business, or the sum of 20% of the W-2 wages with respect to qualified trade or business, plus 2.5% of the adjusted basis immediately after acquisition of all qualified property. This goes a little bit deeper. And so again, this will make sense once you actually have your facts and circumstances in front of you, then we'll be able to apply it accordingly. So I want to make that clear. There's going to be W-2 wage limitations. what you want to do is make sure you talk to your CPA, talk to your tax advisor. If you work with us, you talk to us, and we'll literally figure out how this applies to you and show you what the application of it is. So again, because I'm doing a webinar, I can't go too specific because everybody who's watching this will have different facts and circumstances, income that they're going to generate for that year. If that makes sense. Okay, let's go to number 2. The second top deduction is Section 179. Now, a lot of you may not know what Section 179 is. Literally, 179 allows you to take a deduction for certain fixed assets in the period in which you bought it. So historically, if you bought, say, a computer, it had maybe, I think it had a 5-year useful life. Or furniture is a 7-year useful life for tax purposes. So say you bought office furniture for your office and it cost you $10,000, you were supposed to depreciate that over 7 years, okay? Or you bought a computer for $2,000, depreciate that over 5 years, okay? So that's $400 a year you can get a deduction for, and that was it. Now with 179, it allows you to take the full deduction in the year in which you bought it if you meet certain conditions. Now the reason why this is an additional deduction is because the limit used to be $500,000, and now the limit has been raised to $1 million. Now maybe you're watching this, you're thinking, I don't buy equipment that's $1 million or $500,000 or even $100,000. You never know. If you're a manufacturer, maybe you have a printing press, maybe you do T-shirts, maybe you have to buy servers, office equipment for a bigger office. Maybe you're scaling. All that is part of it, and you may end up in a situation where the limit used to be $500,000. Now you can go out and actually acquire more assets, more capital assets, more equipment for your business, maybe car fleets or trucks, depending on what you're spending your money on. And you can actually depreciate. You can actually take the deduction. The limit is up to $1 million, and you can take the deduction in all in that current year. Right? That makes sense. So, like I said, they raised the limit from $500,000 to $1 million. This also includes now, the reason why this also is good, because it also includes other things that otherwise weren't part of it. So historically, you couldn't include these things, and now you can. So you can include improvements to non-residential rental property. That could be commercial space. So if you put in an HVAC in an office building you own, right? Now you can take 179 for that. You don't have to treat it as fixtures. You can actually take the deduction in a year. You can take replacing a roof, adding or replacing or fixing the alarm systems or sprinkler systems, right? In many cases, that can be very, very economically fruitful experience. And so being able to take that deduction is huge. Now let's go to number 3. Number 3 is the 529 plan. This is another deduction for people who have kids who are already putting money towards their 529. I want to tell you this. The change that happened for this particular tax bill now allows you to use the 529 funds for other non-secondary schools, so non-post-secondary school. So in the past, your 529 was only for college. If your kids are going to college, you had to put money in 529. It can only be used to pay college expenses, room and board and books and tuition, right? Now that also includes elementary schools, right? Private schools, private secondary schools, high schools, religious schools, right? Vocational schools. And so all those things have actually been added. So you have other ways for you to spend your money for your 529 plan. And there are I've had clients who have 529 plans, and they end up having inquiries with the IRS because they were wondering if the money was actually used to pay, their children's tuition. Now you can use it for any tuition, whatever other child you have. Now, how amazing would that be for you to be able to save money and earn money, use that money as a deduction to pay your child's tuition and for school or room and board or whatever school they're going to, right? Now let's go to number 4. This one is this actually is going to be good for employees. So if you have any employees, it's actually pretty good. And if you have any of them who take either paid sick leave or paid family leave or medical leave, right? There are people I work with who literally are on medical leave. We all know somebody who either has given birth or maybe their spouse or significant other needed to take family leave to help out and stay home. Now employers get a tax credit for paying for family leave. How awesome is that? So, historically in the past, there was no tax credit. So if you took family leave and the employer paid for it, obviously the employer can get a deduction. But the employer gets a deduction and they get a tax credit. No, I mean, I was gonna say how awesome is that, but that actually is pretty awesome. So let me find some more. I'm give you a little bit more color to that, so that we're on the same page. And then we'll move to B about getting divorced and taxes and stuff like that. Sorry, my voice just kind of jumped. So let's go. Employee credit for compensation paid to employees on paid family medical leave. So this is only for 2 years. So if you know anybody, so in essence, I guess what you could say is if you are in a situation where you have employees who are having kids or about to give birth or anything else, maybe it's encourage them to do so. I'm kidding. Don't send me an email or a letter saying I went overboard. I'm just saying, if you have any employees who are about to take either family leave or a medical leave for 2018 and 2019, that's the only time you can. And if the employer has a written policy in effect under which full-time employees can receive not less than 2 weeks, right? So at least 2 weeks, as well as a proportionate amount of time for part-time employees, but part-time employees, or annual family leave and medical leave under the FMLA Act of 1993, they'll be entitled to a general business credit equal to 12.5% of the compensation that you paid them for that particular employee. So you can get up to a 12.5% tax credit. Now, here's the difference with a tax credit versus a tax deduction. Tax credits are great. If you can get tax credits, always get them, and here's why. A tax credit reduces your tax liability dollar for dollar, unlike a deduction. So here's an example. If you owe the IRS $1,000 and the IRS says you have a $500 tax credit, you subtract the $500 tax credit from the tax liability and you only owe $500. Now, if you have $1,000 in income and they say you have a deduction of $500, what would happen is your taxable income is $500 times the tax rate. So there's a smaller tax effect for the tax deduction that you don't get from a tax credit. The tax credit is always more favorable in many cases, mainly because it reduces your actual tax liability dollar for dollar. So that 12.5% of the tax credit actually can lower your taxes even more if you have to pay taxes, in addition to the 20% tax, tax deduction that you may get from a pass-through, in addition, right, to the lower corporate and personal tax rates. So if you're in a situation where your corporate tax rate is dropped from 39 to 21, in addition to the tax credit, you may even be paying less in taxes as a result of that. Okay, perfect. All right, now we're going to go to B. B, the next point I was going to share with you about getting divorced in 2018. Simply put, the new tax bill literally states that alimony is no longer deductible. So in the past, before the bill was signed, if you paid alimony to a spouse, you paid $10,000 a month or $100,000 a year to a spouse for alimony, you were able to deduct that amount of alimony on your tax return, and then your spouse had to include that in income. So you got the deduction, and then the ex-spouse you paid would have to pay taxes on that, right? Now, it's no longer deductible, and the ex-spouse no longer has to include it in their income. So it's no longer a taxable event, okay? So getting divorced in 2018 or 19 is, maybe not good. Now let's go to C. C, which is the big write-off that is going away and that will cost you thousands of dollars. Now, a lot of small businesses have been reaching out to me about this. This is something that actually is really, really important to think about. And also, I'm going to share with you a strategy that I think is something you should actually consider. And if you're not thinking about it, you should think about how you can maximize your tax deductions by how you categorize the deduction as a whole. That's what matters. So, employers' entertainment expenses are no longer deductible, and that's actually something that's already happened, and that's going to hurt a lot of small businesses. If you take your employees out, fringe benefits, right? You take your employees out to dinner, and that's fine. You take them to an amusement park. Maybe you want to take your employees to Six Flags or Canada's Wonderland. Sorry, that's in Canada. That won't apply here. Or King's Dominion, or wherever else. You take them to an amusement park, take them to the bowling alley. If it's entertainment, right? If it's entertainment, it's no longer deductible. Now, if you have a business meal, like you go out with a client, you go out with employees, and you guys have a meal and you discuss business-related items and topics, that is still subject to the 50% limitation. So you can only deduct 50% of all your business meals. But any other type of recreational expense or entertainment expense is no longer deductible. And I don't know if this is going to phase out. And this is actually going to affect people who go out and schmooze a lot, right? If you go out and schmooze and have dinner, totally fine. Now, if you're taking your client to go golf, you're not going to be able to take that deduction anymore. If you're taking your client to go to the strip club, you can't get a deduction anymore. Now, I'm not saying I'm not condoning or advocating any of that stuff. I'm just saying in general, because there are people who do. And if you're in that situation, you can no longer take the deduction for those particular activities, right? Now, if it's a meal, you can. So then you have to take a look and see, and literally recategorize and literally just change a category. What am I really doing? Am I eating at these events? Is this more food and more of a meal than than an entertainment experience of sorts, right? So that's the thing that I want you guys to think about moving forward is how's your accounting? Talk to your accountant, speak to your CPA, to your tax advisor to determine how you may have to recategorize the accounts that you have on your ledger and how you book things. And just take a look. I'm not advocating for condoning to do anything differently. I'm just saying just take a look at how you spend your money and the way you would spend your money from an entertainment perspective. Instead of doing entertainment, maybe just do meals, right? Now, another thing too is in many cases, if you're taking your employees out and you want to reward them, say for example, when I used to work at Deloitte & Touche and PricewaterhouseCoopers, we at the end of busy season when we were done with tax season, all 100 or so people at our group, in our tax group in that office would go out for a wonderful meal and some cocktails and drinks and hang out, and it's kind of like an end of busy season party, right? And historically, what you do is they take the deduction, the meals, and the entertainment and all that stuff, right? Now, in many cases, if you're limited now, i.e. the meals is 50%, which has always been, but the entertainment is no longer deductible, how about you give them cash instead? Right? Or think about it. This is kind of the strategy I want you guys to think about. In lieu of giving them actually the experience and going to play golf or going to amusement park, give them the cash. Find out what they really like and what they care about. And if it requires you to pay a little bit more, then do so. Why? Because you can get the deduction for that. Take a look at something that give them the cash and say, use this cash. Here's the cash. I know it's really important for you to go take cooking classes. Rather than having an event for everybody to go do cooking classes, here's a $200 gift card for you to go to Sur La Table so you can learn how to cook. What effect would you have on your employees if you can do that? And in the meantime, actually save money on taxes. Just give them the cash, right? Cash is cash. Treat it as a bonus. Give them the cash and take the full deduction and treat it as compensation to your employee, bonus compensation to your employee, right? Now let's go to the last one. This is going to be D. Discover how to get tax-free money if your home is destroyed. Now that kind of sucks if you're in a situation where your home gets destroyed, but I want to make this very clear. Part of what was added to this particular bill, and there's a bunch of other things here that are really important. If you want to learn any more, I'm going to put the link. What I'll do is I'll put a link here someplace. If you're watching the replay, if you're here live, I'm going to put it here so you can actually catch the replay, but also you can also book 15-minute time to talk for 15 minutes. Okay, so there's one I want to pull out for you, a disaster area. So if you're in a disaster area, if you were in a disaster area in 2016, now we all know what a disaster area is: Puerto Rico, Houston, parts of Miami, Florida, the Panhandle, because of all these, or the U.S. Virgin Islands. All these islands and coastal areas that got destroyed, right? If you're in this area, you can pull money from your retirement account, 403B, 401k, whatever else you have, without the 10% penalty, up to $100,000. So this can literally save you $10,000. Now, again, I'm not saying pull out the money and just do whatever. The reason you're pulling out the money is maybe because your flood insurance didn't kick in. Or maybe you need to literally buy a new home or rebuild or whatever it is, and you don't have the insurance in order to do that. All those things together, if you need to pull out money from your retirement account, historically, before this bill was signed and put into place, if you pulled any money out of your retirement account, with certain exceptions, you had to pay a 10% early withdrawal penalty. That's automatically in addition to the taxes, right? So you have to pay tax in addition to, there's additional tax of 10% for whatever you pulled out. You pull out 100 grand, you got to pay tax at whatever, 30%, whatever it is, 35%. In addition, you pay another $10,000 because you pulled it out early, right? So now they're saying you no longer have to pull, you no longer have to pay the withdrawal penalty of 10%. You can pull the money if you live in a disaster area, okay? And so it has to be designated by either FEMA or the IRS, and there's a way, there's probably some more guidance on that and how you can actually do that, okay? That's really key. I can save you $10,000, up to $10,000 if you do it right. Now, the thing is this: the new tax reform bill, don't be worried about what you're seeing and what you're hearing, right? You got to understand something. The media, they're literally run by the merchants of chaos. Their goal is to get you confused, get you worried, get you freaked out. They'll have people come on telling you all these things to scare you. And the main reason why they're doing all this is to get you to do something. Get angry at the bill, get angry at Democrats, get angry at somebody, get angry at yourself, whatever it is. Fill in the blank. Buy something, sell something. They want you to act. So what I want to suggest to you is, depending on when you're watching this, reach out to us, schedule a 15-minute call. I want to learn more about your situation, your facts and circumstances, so I can literally apply the new tax bill to your facts and circumstances. In some cases, you may get additional deductions, and in other cases, you may get no deductions. But you'll never know specifically just from listening to or hearing the overview of what the new tax, some of the top deductions from the tax reform bill. My goal is if you have a W-2 or you have a pass-through, maybe you have a side hustle and you're making money on the side and you have a business like an LLC or an S-Corp or something to that effect, and you're looking to get your taxes done, get them done right by somebody, reach out to me, 15-minute quick, free consultation. We'll talk about your situation. If there's a fit for us to work together, we can get started. In essence, we probably get your stuff done relatively quickly. We work remotely as well. We can also work in person if you live in the Washington, D.C. area. Our offices are here in Tyson's. You can also meet with us, again, virtually. We do something like a Zoom call. We have a quick conversation. We see each other. And then we have a process in which you follow. Fill in the information, send it back, and then from there, we get your returns prepped, gets reviewed by me and others in our staff, and then we get done. We can e-file it relatively quickly if you have all the information all set. So, and the goal for us is to give you what you need so you can make decisions about your life and your business, not have to worry about something like taxes because, again, nobody knows what the hell's going on in many cases, okay? So, again, don't miss out on this opportunity. I won't be having this run very long. As we get closer to tax season, I shut it down, mainly because we already have all our processes going and the system going and the economic engine's going. And so we won't be able to take on more people, especially at the rate in which I'm mentioning it right now. So if you want to learn more, just you can join our Facebook group, but also schedule a call. It's not a very difficult thing to do. What you want to do is schedule a call, and so we can have a conversation and how we can talk about how specifically what can help you, what can hurt you for taxes, how to prepare for 2017, but also how to 2017 tax filing, but also how to prepare for 2018. What you do for this particular tax return will help you in 2018's tax return, and that's the thing that we're trying to help with so many people. What I don't want to do is I don't want you to put it off and worry and think about all these things, and then eventually you make the mistake and miss out on something that can be really, really fruitful for you. So what I want to do, I'm going to put literally the link in here, depending on where you're seeing this. If this is a repeat, what I will do is, if you're watching a replay, what I will do is I'll add the link somewhere in the video. You can see this. If you are watching this live, if you're in the YouTube group, in the Facebook group, I will make sure that I add this as well. And let's see. So again, if you have any questions, You can leave them below. If you're watching this in the Facebook group, leave them below. If you're watching this remotely, if you're watching this again, the replay again, you can reach out, set up a call, let's have a quick conversation. Let's get started. You know, your tax work, your tax returns, and get started for this tax season. I want to thank you for watching. I told you I wasn't gonna keep you. I want to thank you for watching. I want to thank you for being here. All your questions, send them to me. Jump in a group, put them below. We'll have a conversation. And again, joining a group is important because I'm going to continue to add videos of these types of trainings on a regular basis. So maybe once a week, I'll be adding another training, whether it's about pricing, whether it's about taxes, whether it's about sales, closing, how I find my high price clients, all these different things I'm going to be helping you with. Maybe even Monday motivation, it's multiple different things. So you want to make sure you join the Facebook groups. That's the way you can stay in the loop and you can learn more about how to not only run your life, but also run your business. My goal is to help you do that. So I want to thank you for watching today. Thanks for being here and take care. I'll see you soon.